The following presentation highlights the strategic decisions, performance trends, and lessons learned that have driven Bionic Wings' company growth and competitive position in the Globus simulation during this course. Since taking over management of Bionic Wings in year 6, our team has delivered a consistent and sustained financial growth record across all key performance measures. Return on equity, ROE, surged from 16.8% to 91.8%, indicating highly efficient use of stockholder investment. Stock price increased more than 13 times from $21.55 to $293.61, recovering strongly from a year 12 dip and aligning with EPS and ROE gains. Our credit rating has remained strong at A, signaling low financial risk and disciplined capital management. Our image rating has improved from 82 to 90, supporting premium market positioning and brand value. Our total revenues grew from $448 million year 5 to over $1.08 billion in year 14, driven by expanded market share, high product quality, and strong marketing execution. Overall, our leadership has built a high-quality, financially strong, and competitive company that consistently delivers value to shareholders. Our total revenues have more than doubled since year 9, with consistent year-over-year gains by strong brand positioning and expanding market share. Bionic Wings company total revenues grew steadily from $622 million in year 6 to a peak of just under $1.1 billion in year 14, reflecting strong demand in both AC camera and UAV drone segments. Early growth from year 6 to year 9 was driven by unit sales expansion across multiple regions, supported by targeted pricing strategies and marketing investments. While year 10 saw a slight pullback due to intensified competition and price pressures, revenues rebounded sharply in year 11 to $872.6 million and crossed the $1 billion mark in year 12. Subsequent years maintained momentum, reaching $1 billion in year 13 and a record $1.09 billion in year 14. This consistent top-line performance highlights our ability to capture market share and sustain growth across product lines and geographies. When we assumed management of Bionic Wings, our earnings per share in year 6 was $1.05. Over the course of this simulation, we steadily improved profitability through a combination of targeted cost controls, strategic pricing, and market share growth. From $3.26 in year 7 and $3.76 in year 8, earnings per share climbed to $4.29 in year 9 and then surged to $6.22 in year 10. This upward momentum continued with $7.55 in year 11, a slight dip to $7.37 in year 12, but overall reflecting consistent operational efficiency and revenue expansion. In the most recent years, our earnings strength became more pronounced: $8.77 in year 13, $10.78 in year 14, and a projected dip in year 15, however, demonstrating our abilities to sustain competitive performance even amid shifting market conditions. Overall, we delivered an average EPS of over $6.17 across the simulation, signaling a strong shareholder value, growth, and positioning for the company for continued profitability if the game were to continue. Bionic Wings maintained a stable and progressive return on equity trend, with growth from years 6 through 10, followed by a significant surge in year 11 that closed much of the gap with our leading competitor. The entire market experienced a reset during years 12 and 13, after which we rebounded strongly in year 14. While year 15 projections are still preliminary, early indicators point to a slight overall decline in the market. The market has held a stable credit rating across all the major corporations that were involved. There are only a few anomalies. Our stock price has increased more than 13-fold since year 6, climbing from $21.55 to $293.61 in year 14. We saw rapid early gains as our brand and market position strengthened, followed by steady growth through year 9. The most significant acceleration occurred during years 10 and 11, fueled by rising EPS and ROE. After a temporary dip in year 12, we regained momentum with strong financial results, operational efficiencies, and a stable image rating in the upper 80s to 90s. This trajectory reflects consistent shareholder value creation and positions us well for continued growth.
Looking at our team's imagery rating history, there is a clear pattern. Between years 6 and 9, we saw gradual fluctuations, roughly between 82 to 88. In year 10, we had a significant drop to 83, but we recovered strong in year 11. From year 11 to 15, we stabilized to a high end of between 89 and 90, with a projected 90 image rating for the end of year 15. Our vision is to be recognized worldwide as a leader in premium, high-quality cameras and drones. We will achieve this by sustaining image ratings above 90 through ongoing innovation, expanding our global market presence, and targeting growth opportunities in underdeveloped regions like Latin America. Operational excellence remains a priority with a focus on automation and training to keep costs low and productivity high. By maintaining financial discipline, we can continue to deliver top-tier return on equity and earning per share growth, ensuring long-term shareholder value. Above all, we will foster brand loyalty by providing unmatched customer experience and products that deliver on their promise every time.
For the next 2 years, our target focus on building the strong foundation we have established. EPS is set to rise from $9.27 to $10.78 in year 15 and $11.50 in year 16. ROE will remain above 100%. We'll maintain our A credit rating and aim to keep our image rating in the 91 to 92 range, supporting premium brand positioning. Stock price is projected to climb to $325 in year 15 and $365 in year 16, in line with our EPS growth and shareholder value goals. From the start, our strategy has been centered on premium differentiation by delivering top quality products that justify higher prices. Early years focused on PQ investments in marketing to establish brand credibility. Later years balanced cost control with selective market expansion. We've maintained leadership positions in Europe, Africa, and Asia Pacific, and Latin America has been our largest untapped opportunity. Operational efficiency and target promotions have allowed us to compete effectively without sacrificing margins. We've expanded our in-house assembly capacity strategically, keeping overtime use controlled and only for short-term surges. Our workforce strategy paid above industry average wages and emphasized training, both critical for sustaining productivity and quality ratings. Automation investments ensured efficiency gains kept pace with our volume
Our
growth.
financial strategy balanced investor returns with operational reinvestment. We've maintained an A credit rating through conservative debt use and prudent equity management. Dividend increases have been steady but measured, always tied to actual EPS performance. With our projected EPS above $10 in year 15, we see room for modest dividend growth over the next 2 years. In the overall market, our closest rivals in the last 2 years have been Company A and Company F. In AC cameras, Company A is our primary competition, matching our PQ levels and brand strength. In UAV drones, Company F has been aggressive, particularly in maintaining high PQ and margins. We're also keeping an eye on Company D, which has shown market share growth in targeted regions for us. To outpace our closest rivals, we'll maintain our PQ advantage, ensuring our UAV drones and AC cameras remain industry benchmarks. Pricing will remain premium in mature markets, but be more aggressive in Latin America to capture share. Product innovation cycles will be timed to preempt competitor launches, supported by digital marketing and localized promotions to strengthen brand visibility. Operationally, our focus is on expanding in-house capacity to meet demand without costly overtime. We'll invest heavily in training and retention to ensure our workforce remains the most productive in the industry. Automation and process improvements will drive cost reductions, keeping us competitive on margins. Financially, we'll reward shareholders through steady dividend growth and selective stock buybacks, all while protecting our A credit rating.
We learned that a sustained competitive advantage comes from never letting quality slip. Profitable growth means protecting our margins while strategically expanding our market share. Understanding the unique needs of each market segment allows for more precise targeting. Workforce investment in pay and training has paid off in both quality and efficiency. Maintaining an A credit rating gave us flexibility and low borrowing costs. Most importantly, rapid adjustments to counter rival strategies has kept us from losing ground within the marketplace. On the flip side, overexpansion without demand can trap capital in underutilized facilities. Cutting marketing spending to boost short-term profits hurts our long-term brand equity. A one-size-fits-all pricing strategy ignores regional realities, and too much overtime can hurt both our operating margins and workers' morale. Excessive debt threatens financial flexibility and can lead to credit downgrades by the credit bureaus. Most importantly, complacency is dangerous. Rivals will close this gap, and if you show any lack of innovation or responsiveness, you will suffer the consequences for your complacency.